Welcome to Market Catalyst. I'm Jared Blikre. We are 30 minutes into the U.S. trading day, so let's get to the 3 market catalysts we are watching this hour. First up, we have full market coverage ahead of all stocks entering the final trading week of the year. Plus, we're going to hone in on the commodities rally as silver and copper touch fresh highs, and we're going to bring you a defense stock playbook and tell you how you should trade the sector in 2026. So let's take a look at the Wi-Fi Interactive here and check out what the major averages are doing. A little bit of downside to begin the week here. Let's take a look at the intraday chart. You can see a little bit of red there. I'm going to put this on a 3-day view because this is the 3rd trading day of the Santa Claus rally, which began December 24th. It is the last 5 days that are trading in 1 year, and that is 2025, and the first couple of the next year. So we're going to be tracking this throughout the week. And here we have the Dow up about 26 basis points. That's 0.25% over this time frame. NASDAQ Composite is in the negative. We've seen tech a little bit of a sore spot lately. We'll see if we can overcome that. And the S&P 500 just about break even there. Well, let's take a look at the bond market as well. And I'm going to switch over to an intraday view where we see 10-year T-note yield. That has been going sideways for a long time. It's down about 3 basis points today to 4.11%. And the 30-year, that is down 2 basis points to 4.8%. We'll also check on the US dollar index. That is just slightly negative today, but nothing too big in the bond or currency markets that I'm seeing right now. And if we take a look at the large cap sectors, energy is leading the pack. It's up 0.2%, followed by utilities, real estate, staples, and healthcare. So that is a very defensive playbook, and we're going to be checking that out as the day progresses here. To the downside, we have materials, consumer discretionary, and tech. Those are the 3 laggards here, and a lot of that has to do with some of the mega caps that we're seeing in the NASDAQ 100. You're going to see a lot of red on this side of the board, except for Apple. Amazon's just barely breaking even. But look at that. NVIDIA down 2%, the largest stock there, over $4 trillion worth. Meta down slightly. Tesla down 2.5%. Broadcom down just over 1%. And digging into the semiconductor industry, we do see a few bright spots here. Micron up 0.33%, so is Intel. But software looking a little bit better, not too bad, not too much better. Looks like Salesforce up about 0.5%. And I got to check in on the futures because we have seen metals soaring recently, but not today, because look at that. Palladium down 15%, platinum down 13%. I'm going to show you a year-to-date chart so you can see how these markets have just gone absolutely parabolic recently. And that means the large gains that you see to the upside one day, sometimes you're going to see those down the next day. The markets become very unpredictable. But a lot of these markets at record highs. Also silver, mentioned that in the open. Got to check that. That is down 6.5%. But look at that, year to date, still holding on to gains of about 143%. One final thing, I do want to check in on crypto. Seeing a red board here. We're going to be taking a deep dive into crypto in a few minutes, so stay tuned to that. Tech is capping off a blockbuster 2025 driven by AI infrastructure spending that fueled much of the sector's gains. But as we head into 2026, the story is shifting from pure growth to execution, competition, and also risk. So for more on this, we're going to bring in Bob O'Donnell. He is the president of Technalysis Research. Bob, it is great to see you here. And we talked about this earlier in the year on Stocks in Translation. So give us an update. What do you see the AI? What has been the dominant theme of AI? Excuse me, I was leading you there, of the AI trade this year. And kind of heading into next year, what are you keeping your eye on?
No, fair enough, Jared. Thanks for having me, of course. Look, one of the things we talked about back on that program was this notion of hybrid AI. And by hybrid AI, what I was referring to and continue to talk about is this idea that we're seeing AI being deployed, of course, in the big clouds, and we're seeing a lot of benefit from Google and Amazon and Microsoft and those kinds of companies, Meta as well. But we're also starting to see businesses themselves start to deploy AI. And so this hybrid AI idea is that the fact that you can do some of this AI computing in the cloud with the big LLMs, but you can also do it on your own premises or within data centers and things like that. So that's where a lot of the excitement is, because that's where there's a huge long ramp of growth and opportunity. And so that's from companies like Dell and HPE, Cisco, some of these other companies who sell some of the servers that the companies are buying. Of course, they include NVIDIA chips or AMD chips, and I think we'll see a lot more competition in AI accelerators in 2026 as well. But the point is, a lot of those companies, and then the software that they're building and creating with that is driving a whole new wave of opportunity. And that's, like I said, that's sort of that hybrid AI story. We saw the beginnings of it in 2025. I think we'll see a lot more of that in 2026.
And let's shift the discussion right now to a little bit more forward-looking. I know one of the things you have your eye on for next year is also cybersecurity. Tell us about the importance of that and any plays you might have in that regard.
Well, I mean, look, what happens with cybersecurity is that both the attackers and the defenders have gotten much smarter and much more capable because of AI. And so there's a fast race to see who can outpace each other. I mean, that's always going on, but the speed at which that is changing is just incredible. So you've got all your traditional players. We've seen obviously a lot happen with Palantir. You've got companies like Palo Alto Networks. You've had CrowdStrike. We've got a bunch of the sort of traditional security names that are all diving in. There are a whole bunch of little startups that may make some kind of a play or be acquired sometime in 2026. But there's no question that every single organization who's doing this is going to have to be doing AI, that is going to have to think about it. And especially because, of course, the theme of 2026 when it comes to AI is agentic AI.
Yes.
The idea that we will have agents that are actually acting on our behalf using AI. And that notion of all this agentic AI has been a huge theme over the last couple of months. I expect it to continue in 2026, but security around agents is huge.
Let me ask you about that, Bob, because I know one of your talking points here is that we might have some of these agentic AIs or these AI agents go rogue. What this reminds me of is way back in the late teens when we were talking about autonomous vehicles, and it seemed like every time there was an accident with one of these vehicles, it just got national headlines and it spooked people. And I can't help but think the same thing is going to happen here, but what are the market implications? How do you think this affects the industry and some of the trading around it?
It's a great question, Jared. And yeah, I mean, one of my concerns is if we indeed get these billions of agents starting to run simultaneously, inevitably there's going to be huge questions around that, hence that point about cybersecurity. So look, I think we will see a lot of progress in agentic AI in 2026. And all of the major cloud players, all of the major LLM providers are all working on developing agentic capabilities. But I am very concerned that we're going to see a few stories where things go awry, and that's going to put a pause on some of that agentic work. And so I think there's going to be a lot of trust issues, and all of that could eventually, of course, have blowback on some of these big tech companies. And, again, even though I think that AI is going to do just fine in 2026. It's these little signs. If we see little signs like, agentic starts to become an issue, then that becomes an incentive for people to say, see, it's going to blow up. So that's part of the reason I'm concerned about it is not just what it's going to happen, but the fact that it's going to present a concern that people who are sitting on the sidelines just waiting to pounce on a problem to go, see, there it is. And sometimes those things, snowball. Hopefully not. But that's something you got to be aware of and sensitive to.
Well, and another thing people have been, some of the critics have been pouncing on is all the spending, the capital expenditures, so-called CapEx. We saw that it's been exploding over the last few years. It's set to continue next year. But we've seen in the Mag 5, for instance, we used to kind of talk about them, or the Mag 7 as a whole. It's really only Alphabet and NVIDIA, maybe Tesla as a come-behind story, that have really surged this year. So is it a game of have and have-nots, or how do you see this playing out?
No, it's a great question. I mean, look, I think NVIDIA obviously continues to do well, but I also am certain that NVIDIA is going to get a heck of a lot more competition in 2026. AMD is, an obvious one, but there's a lot of other little players. I mean, NVIDIA's deal with Grok recently to bring more of their technology in is a reflection of the fact that we're seeing more specialized types of models being developed. We're going from the days of big general purpose LLMs that you can use for everything to much more specialized areas, and each of those are going to require different types of hardware, and I think in turn that's going to create additional opportunities, but it's going to create more diversity, which is going to be a little harder to figure out. But obviously I think you're going to continue to see folks like NVIDIA, AMD do well. As I said, I think you're going to start to see some of the smaller the cloud guys who are doing custom chips often through Broadcom will also start to benefit. We've seen already, Google's been doing more with TPUs. GPUs. Amazon has their Graviton chips. We've got a bunch of other companies. Microsoft is doing custom chips. A lot of these are ARM-based. So ARM is another company, we haven't been talking about them a lot lately, but ARM's helping drive some of this innovation. Intel, as you've talked about, is doing well. They continue to plug away. Obviously, they had their challenges last year, but things are looking better in 2026. So I think we're going to see a lot of different players from different areas all start to come together. And we'll see some smaller companies. There's a little company called SciTime that does timing chips. And all these networks have to be completely aligned from a timing perspective. They're doing some interesting stuff. So I think there's a lot of different opportunities in different areas. But we're going to have a lot of the bears on the side, just again, waiting to pounce on these concerns that get raised, I think, around agentic AI.
And we'll have to see if those are dips worth buying or not. And Bob, what I'm realizing is we got to do another podcast real soon. So thank you for showing.
Yeah, man, I'd love to.
It was great seeing you here.
Thanks, Jared.
All your markets action is ahead. Stay tuned. You're watching Market Catalyst. Pending home sales data crossing the wire now. Data from November showing U.S. pending home sales jumped to the highest level since early 2023. An index of contract signings rose 3.3% to 79.2 last month, and that's according to figures by the National Association of Realtors. The recent data point to a gradual improvement many economists saw for the year ahead. Mortgage rates that were close to 7% in May have since settled in the 6.3 to 6.4% range. That has helped fuel small gains in the contract closing stats in recent months. And the latest report showed contract signings rose in each U.S. region last month to their highest levels of the year. The West posted the largest increase, followed by the South, which is the nation's largest home selling region. And pending home sales also tend to be a leading indicator for previously owned homes, as houses typically go under contract a month or two before they are sold. And a brief rebound of sorts for Bitcoin. The cryptocurrency broke above the $90,000 price level overnight before backpedaling. Let's bring in Andy Baehr, CoinDesk Indices Managing Director, for a look ahead to what we might see from crypto in 2026, as well as a broader volatility picture. So Andy, great to see you here. All right, I try not to get involved when Bitcoin is going sideways. It's been going sideways for 6 weeks, but some technical developments have happened. And you tell me, is it time to go long finally?
Well, we were just talking before that you astutely pointed out there was a big options expiration on Friday. And before that, most of the dealer community was basically long optionality, and they were their hedging activity was helping to kind of pin Bitcoin into where it's resided in the sort of the high 80s for the last couple of weeks. It's been kind of a numbing and confounding market, right, since this liquidity event that the market had on October 10th.
Big sell-off, yeah.
Right, big sell-off and big liquidity event that kind of really spooked the market pretty good and drew out a lot of the fast money into other places, has given us basically a heartbreak quarter, which has ended a year where a lot of the slow money progress in integration and legislation and building in M&A has been great, but the fast money seems to have evacuated from the token space. So I guess the best way to put it is I think Bitcoin and the rest of the crypto market, its attention span seems to be a quarter. Things happen in quarters. We've had almost exactly a solid quarter of downtrend, so this too shall pass.
Yeah, I like that because guess what? It's the end of the quarter.
It is.
And I think the first quarter has been a pretty good time. The beginning of the first quarter has been a pretty good time to buy Bitcoin. And if we go to the Wi-Fi Interactive, I'm just going to show a chart real quickly because I was mentioning to you also, I like the technicals. Here's the year to date in Bitcoin, and we got a pretty steep trend line. And you got to be careful about these sometimes, but we have just crossed over that. So you gently step over that. I would point out here, 75,000 is the low of the year. I'm going to put a 2-year chart. That was a year to date. And so here's that same level I just highlighted, 75,000. It was also the peak the prior year. So kind of a line in the sand for a lot of investors. Where do you see the money coming into Bitcoin? The ETF, I keep hearing all these new companies finally onboarding Bitcoin onto their platforms. Anything there?
I think the bullish case for Bitcoin is that its investment thesis is intact. I think what's happening a lot with other tokens, right, with everything from Ethereum all the way down is people are starting to scratch their heads and say, I get that there's going to be more adoption of blockchain technology, but what does this token have to do with it? How do I relate those two things into an investment thesis that gets me in for the long term? Bitcoin on its own, it's fine. Store value, it moves from one place to another. It has a very simple purpose. and therefore people who want to invest for the long term can kind of count on that. The precious metals have taken away a lot of the fire in terms of the debasement trade, but there are a lot of technical reasons and geopolitical reasons that are driving those movements as well. So I think you point out some really interesting levels of that $75,000 level, which was due to some flush outs of perps back during the taper tantrum back in Q1 of last year, right? That was kind of a region where we haven't had a lot of price discovery. Remember, after the election in 2024, Bitcoin raced from about 69,000, pretty
very
close
quickly.
to very quickly, right? So there wasn't a lot of kind of price discovery and kind of settlement there. Things just raced up. So that's a tender area, that sort of $85,000 to $75,000 level. We've held on to 85 pretty well. We've seen, as you pointed out overnight, whether it's been MicroStrategy buying or option dealers being short gamma, that the race up to 90 can be pretty fast. And then we'll have to see where things go from there. We don't have a lot of the baggage that we did in the first quarter of 2025 with the inauguration and then with an immediate tariff policy. Things seem a little smoother with a little bit more precise expectations for the Fed. So if things roll out pretty slowly and a trend begins to develop, I think investors can start to watch that and make their decisions there.
Another thing I remember from the beginning of last year, there was, as soon as Bitcoin made that humongous rally into the inauguration, and it stopped shortly thereafter, I heard $200,000, $300,000 price targets. Those were coming out pretty quickly. And we had probably, arguably, the most favorable regulatory backdrop for crypto in a long time, if not ever. Without those tailwinds, though, I mean, what has to happen? What's the catalyst that gets Bitcoin to 200?
Great. It's a great question. And I think the answer is not in Bitcoin. The answer, and what ended up happening a month later, was that Ether found a bottom and had its massive, very powerful rally. Ether was the poster child, was the representation of blockchain technology, stablecoins, tokenization, payments, things like that being adopted. And that led a massive rally which had breadth. Bitcoin needs breadth.
Yes.
Breadth needs Ether. Ether will lead the way of the adoption and technology names. High quality names will benefit more than low quality names. So I think ETH is a very, very important name to watch. It's starting out the year or ending the year around 3,000. The high was around, a little bit short of 5,000. So keep an eye on ETH for the adoption of blockchain technology representing itself into investments into tokens outside of Bitcoin.
Yeah, I'm so glad you mentioned breadth because I'm a big breadth guy when it comes to stocks, but it also applies to crypto. Yep. I'm going to get you out on this. Anything we haven't covered here or outlook for 2026? I'll give you the floor.
Yep. We have an index called the CoinDesk 20, which is now around 3,000, like ETH. It started out around 1,000 in the fall of 2022 when we based it. There's a mid-cap index called the CoinDesk 80. It's based the same way. Yeah. It's under 500, right? So we're really seeing a pull away of high-quality names and important critical names versus low-quality names. Get some diversification, get some breadth. An ETH-led rally will bring a lot of other names with it. Bitcoin will handle itself, and just go for some breadth in 2026.
All right, breadth in 2026. Love it. Andy, thank you for stopping by here. Great to see you.
Good to see you.
And coming up, we are looking at names in the defense space and how investors can play the sector. Stay tuned. You are watching Market Catalyst. European defense stocks falling after President Trump said he made a lot of progress in talks with Ukraine's president over a possible peace deal with Russia. Still, global defense budgets surged this year amid ongoing conflicts, and they are expected to rise in 2026. So joining us for more is Tony Bancroft, a portfolio manager at Gabelli Funds covering aerospace and defense. Great to see you here today. I want to show the Wi-Fi Interactive. We have a heat map of the defense stocks year to date, and there's a lot of green on that screen, from GE in the upper left up 87%, RTX up 60%, et cetera. Lockheed Martin only breaking even there, but that is the exception. One of the things I noticed this year, Tony, was in the post-Liberation Day sell-off, these stocks did very well. They arguably held up a lot better than some of the rest. So that was something I noticed this year. What are the factors that we need to think about going into next year, 2026?
Yeah, great to be with you, Jared. I agree. I mean, a lot of those on the heat map were in our Gabelli GCAD ETF, commercial aerospace and defense ETF this year. So we saw a lot of good things. I think coming up in 26 is probably going to be relatively more of the same. I mean, we saw the news over the weekend with Ukraine trying to have a referendum on the land, and then also yesterday with China doing embargo exercises. I just think there's going to still be a lot of instability globally, and the defense budgets are up globally. NATO, of course, is at 2%, going up to 3.5%. The U.S. is at $1 trillion for 26, and it's likely going to continue. So you're going to see probably some more of the same into 2026 and beyond.
And with all the talk of AI, and sometimes that's all we can talk about, that's naturally the source of my next question, or the subject. How big a factor is this in some of the stocks that we're talking about here? Some companies have been quick to adopt, others slowly. How does this play into aerospace and defense?
Yeah, I think the reality is AI, has a lot of its foundations in aerospace and defense. I mean, all the way back to a simple AI tool, which is an autopilot system. That's all the way back to 1912. You could sort of call that a closed loop feedback system. So AI has been playing a large part in aerospace for actually a very long time. Now, you maybe talking about modern AI, what you're talking about with companies like Palantir and the defense techs, Andurils. You're probably going to still see more of the same. Any way you can automate, optimize. Have autonomous systems that don't need a person involved when it doesn't need to be at low level decision making. You're probably going to see more of that, and the companies that we like are all participants in that area.
You don't want to not mention AI on the telephone call sometimes, especially with the analysts. I want to talk to you about M&A, mergers and acquisitions. The cost of money is getting cheaper. The Fed is lowering interest rates. What are the prospects for this M&A season in Q1? Just bring it out through the whole year into the end of 2026.
Yeah, it's bifurcated. You've got one end of the spectrum, obviously, as you noted. The aerospace and defense industry has run up quite a bit in 2025, so you have high multiples. But on the other end, you still have the laggards that are really good businesses, high barriers to entry, sole source programs. They're ripe for the picking. And companies in our GCAT portfolio, companies like we believe a company called Albany International, which has two businesses, a strong aerospace and defense business, and they've got a industrial business, which the two don't really make sense to be together. We think those could have some type of financial engineering and M&A involved in it. Over the next 12 to 18 to maybe a little further out. But there's definitely companies that have not participated in the run up. Like the rest that are likely going to have some M&A going on this year and next.
And talk to us about emerging technologies. There's a lot going on in that field, from laser weapons, electronic attack aircraft, et cetera. And you have this alongside this movement where we are going into space and we are also weaponizing, for better or for worse. So talk to us about some of those new technologies and some of the opportunities there.
Yeah, you saw what happened in Ukraine over the last four plus years, and obviously what's happening in Israel, Gaza, just inundation of drones. You're going to need drones, of course, but you're also going to need drone defense. And there's only so many missiles that an aircraft or a ship or any drone system is going to have. So you're going to see a lot of you'll see a lot of drone defense either through electromagnetic spectrum, lasers, you name it, whatever Buck Rogers or that you see out there, you're probably going to see that coming, and it's going on right now. It's on the weapon systems right now. You obviously saw Israel, just essentially put out their first Iron Beam for drone defense, and there's going to be probably a lot more of that, especially in You'll see things in like GPS denied environments. You're going to need other forms of navigation. People use magnetic navigation in order to get around, skirting around. If you're in a GPS denied environment, you're able to still navigate in launch aircraft and weapon systems from that. So you're going to see a lot of cool stuff coming up, and it already has, of course.
All right, so we got the Buck Rogers trade that investors should be watching out for. Anything else? This is the final question here. So what should investors be looking for in 2026?
Yeah, I think the reality is you're going to see defense techs are likely going to continue to do well. I mean, we've seen discussions of Anduril, SpaceX doing IPOs this year. And I think just, more of the same on the essentially the maintenance side, maintenance services, and then of course the big one I think that everyone is very keenly aware of is the weapon systems, missiles, rockets, munitions. You heard in the first year of the war in Ukraine, 7 years of munition production on HIMARS, Javelin, Stinger were expended in 1 year. You've heard in Israel, they've launched, in certain months, they've launched 100 Patriots in a month. And, our stock is not far above that. So there's going to be a lot more doubling, quadrupling of weapon system production in 2026 and probably beyond.
All right, got to leave it there. Really appreciate your insights here, Tony. Thank you.
Great. Thanks, Jared.
And coming up, Bank of America CEO Brian Moynihan issues a warning tied to the Fed next year. We're going to break down his comments after the break. The composition of the Federal Reserve will change in 2026, and with it comes a shift in policy. Let's bring in now our Federal Reserve correspondent, Jennifer Schonberger, who is breaking down what investors can expect. Jennifer, so what are the policy implications that we can expect next year?
Hey there, Jared. Good morning to you. Happy holidays. We are going to be seeing a change in composition of the central bank with the new year that could bring implications for policy. At the beginning of every year, we see a rotation off of 4 regional Fed bank presidents who were voting members and a rotation on of 4 new ones. Rotating off of the committee at the beginning of the new year are Kansas City Fed President Jeff Schmid, Chicago Fed President Austin Goolsbee, both of which were hawks and dissented at meetings this year. We will also see Boston Fed President Susan Collins roll off, as well as Alberto Musalem of the St. Louis Fed. Now, rotating on to the committee as a voting member next year are Cleveland Fed President Beth Hammack, Lori Logan of the Dallas Fed. Both of those ladies are hawkish. They have said outright that they are not concerned about the job market right now. They're more concerned about inflation, and they favor holding rates steady at this point. So 2 major hawks joining the committee next year. We will also see the new head of the Philadelphia Fed, Anna Paulson, join. She leans more dovish, however. And we will also see Minneapolis Fed President Neil Kashkari, who will join. He hasn't spoken in public about his views on monetary policy for a good month and a half, though the last time we heard from him, he sort of seemed to lean more hawkish, saying that the bar was higher for further cuts. So net with those 4 members, slightly leaning dovish with the addition of the Philly Fed president. Now, we will also see a new Federal Reserve chair next year who will take the helm in May. And President Trump is expected to name this person early next year, and he has said that this person must favor lower interest rates. So we know that the new Fed chair is going to lean dovish. However, he will have to contend with the rest of the committee. And the rest of the committee at this point, after having done 3 rate cuts, insurance cuts, if you will, at the end of 2025, is more hesitant to do further rate cuts in 26. They've certainly signaled that they're looking to take a pause in January, and they've only penciled in 1 rate cut for the whole year. So while we could see overall a committee that leans a little bit more dovish, there are a number of hawks on this committee that could hold things back and certainly will be loud voices. And lastly, Jared, I just want to add that we need to watch the Supreme Court case in January with Fed Governor Lisa Cook, and whether President Trump has the authority to fire her, because if he does, then she will be replaced by a member who will probably be more dovish. And we also have the Atlanta Fed president, Raphael Bostic, who is retiring in the end of February. We don't know who the replacement will be, if he or she will lean dovish or hawkish. However, that person will not have a vote until 2027.
Great rundown there. I'm going to get my popcorn. I want to ask you, I mentioned Brian Moynihan. He's the chief of B of A, and he made some comments about Fed independence, which you were just talking about. Maybe just tell us briefly about that.
Yes. So as we know, President Trump expected to name a new Fed chair in the new year who will take the helm in May, as I mentioned. And he has said that the requirement is that that person needs to favor lower rates. So there is concern that perhaps whoever the next Fed chair will not be perhaps as independent as every other Fed chair we've seen over the course of history because of what the president wants. The president wants loyalty. And Bank of America CEO Brian Moynihan warned over the weekend on CBS's Face the Nation that the market will punish people if we don't have an independent Fed. And everybody knows that. However, I would just note, as I mentioned, this is a committee that sets interest rates. It's not just the Fed chair. And so if the Fed chair is in favor of lowering rates, but many others on the committee are not, he is going to have to contend with that. So I think we will see perhaps more of a dovish slant, but we could see a very large number of dissents given the amount of hawks that are also on the committee next year. It'll be very interesting to watch in the second half of next year.
Yes, you don't often see this level of division. I mean, we have to see how the year plays out at the Fed. Thank you for that report, Jennifer.
Thanks.
As investors look ahead to 2026, one big question is whether the massive AI build-out is getting ahead of real enterprise adoption. Yahoo Finance's Josh Lipton talked to one strategist about the infrastructure trade. Let's take a listen.
Right now, I think if you look at 26, we're going to have a tremendous amount of volatility. The AI trade is very well understood, at least through my client base. You look at the infrastructure build really outpacing enterprise adoption, and that's the issue. We're going to spend at a 40% clip here for the next couple years. The SOX is up, the semiconductor index is up almost 48% year to date. And if you look at the IGV or the software index, that's been the big laggard, only up 7.8%. So all I think of this is understood. As we look into 26, there's three issues that I'm looking at very, very closely, and we can go into that if you'd like to.
Yeah, I'd like to go into that, and maybe Ted, on that point you just brought up, I just want to drill into that. This mismatch, as you say, between the data center build out and the real enterprise AI adoption. When would you expect, Ted, then to see that enterprise AI adoption story play out? Is that a 2026 story, Ted? Is it 2027? What do you think?
Right now, it's hard to nail down, but I don't think it's 26. The enterprise, there's only roughly 30% of the global 2,000 that's ready to move to Gen AI. 70% is still going through data cloud migration and data cleansing to get into an LLM. So we've got, enterprise, it always takes so much longer than the street is looking at. That mismatch probably goes into 27, 28 is my guess.
And what are the signs and signals, Ted, as investors I would be looking for to say, okay, now we're really seeing AI monetization, not just AI marketing? I mean, am I looking at software spend? Am I watching the cloud businesses? Like, what should I be looking for, Ted?
I think it's well understood that the cloud titans are going to see it in token growth as well as just their overall cloud growth. Where I think it's really instrumental to see enterprise adoption is via your last few guests is in the software area, specifically on the agentic plays, whether it be a CRM, a ServiceNow, a HubSpot, and then the whole security sector is moving to AI. I think if you see robust net new ARR, that's going to be a very good indication of enterprise adoption.
Another theme, Ted, I want your take on, what you wrote about was obviously, the massive CapEx by tech giants But of course, we've seen these concerns creeping up, at least with some names, Ted, financial stress, debt loads. And I'm just curious how you're thinking through that dynamic.
Well, my clients do not want to play names that are negative free cash flow. This is one of these cycles because of this mismatch in infrastructure. It's very capital intensive on this infrastructure build. So the only real names that really have the businesses behind it to really fund the capex is Microsoft and Google, and that Google's up 87% year to date. So with that, I think there's a propensity to just watch and have some dry powder. I don't have a lot of interest in some of the negative free cash flow names at this point. And it's obvious, I think, as we go forward that you're getting indications that whether it be Anthropic or whether it be OpenAI or SpaceX, that the debt market is tapped and it's not big enough, quite frankly, to fund the infrastructure build. So all of these next generation companies are going to have to tap the equity market. And my worry there is very simple. After doing this for a few decades is when you have 4 or 5 major tech companies that have to raise just a boatload of capital, OpenAI has been rumored $100 billion. My worry is that we get sometime in 26 where all these guys come public at the same time and we drain, quote unquote, the equity liquidity lake, if you will. And my PMs are going to be forced to sell some of their winners to fund some of these positions in these new companies.
And coming up, we're going to check on the outlook for the retail sector in 2026, including changes at the top spot for Walmart and Target. Stay tuned. You're watching Market Catalyst. Consumer confidence has been steadily declining, and it's casting a cloud of uncertainty over U.S. retailers as we wrap 2025. But change is in the air, and a new crop of CEOs are slated to take the top posts at Walmart and Target in 2026. Plus, our next guest says that momentum heading into the new year is strong for the retail sector. I'm joined by Sucharita Kodali, Forrester Research Retail Analyst. Thank you for joining us here today. Let's talk about the holiday season and just kind of wrap 2025 and set up 2026 for us broadly.
Well, 2025 did pretty well. There was a relatively strong momentum in spite of consumer confidence levels. Even through the holiday season, we saw stronger than expected numbers. There were a number of estimates that suggested that retail sales would be in the low single digits. Some players even thought it would be negative. It ended up being in the mid single digits, around the 4% range, and even higher than that for e-commerce. So the momentum of retail has been strong in 2025. The big question is what happens in 2026, because there is just so much uncertainty with the economy, with interest rates, and of course with consumer confidence continuing to go down.
And let's talk about Walmart and some of the other big retailers that are getting new CEOs, Target as well. And I don't know if these are on your coverage list, but I'm just going to list them because they're in the news as well. Camping World, Kraft Heinz, Kohl's, Lululemon, 7-Eleven, and it seems like changes in the air. So talk to us more specifically about Walmart and Target, please.
Well, Target has struggled a lot in the last few years, and I am not entirely confident that new leadership is going to right that ship. There are a number of operational and executional issues that they need to address. Walmart, on the other hand, has been on a roll. They have been doing incredibly well for several years. They gained share through the pandemic and continue to hold on to that share. They've invested heavily both in their physical store experience, which is, of course, still the majority of their sales, and they also have managed to continue to take share even in the .com and e-commerce sector. So those are things that are absolutely in Walmart's favor. And it's the new CEO of Walmart likely has a hard task ahead of them because the company has been doing so well. To continue to grow on top of that is not going to be particularly easy. But that said, if there is an economic downturn and if consumers do cut back on spending in 2026, these mass merchants like Walmart and Costco are likely to be beneficiaries.
And talk to us, please, about some of the headwinds that some of these retailers might be facing, and some of them come from the weather. We're expecting a warmer winter than usual. I was just in Denver for the holidays, and it was 75 degrees there. I don't know if that's a trend or just idiosyncratic, but so we got the weather. We also have a lot of uncertainty coming into the new year with interest rates, Fed composition, a whole host of things. So what should we be looking out for there?
Yeah, I'm in Charlotte, and it was in the 70s here too. So there definitely seems to be an issue with warmer weather, which will adversely impact certain categories, like, for instance, apparel, which typically relies on some of that colder weather to make its Q1 numbers. So the big factors that we're looking at, of course, are interest rates. That's going to influence some of the big ticket purchases for anything from appliances to home goods. So that's certainly one factor. You have unemployment rates creeping up, and that certainly affects a significant number of consumers. We've been hearing a lot about this K-shaped economy, and particularly the bottom of the K is where we see that lower consumer confidence. We have an election year coming up in 2026. All of these are factors which may cause consumers to hesitate. On the other hand, at the top of the K, you're seeing the stock market at approaching its all-time high. You have the higher end of the consumer demographic continuing to spend, often driving the numbers higher. You have even luxury retailers, companies like Louis Vuitton, seemingly having a little bit of a rebound in the market as well.
And we got time for one more, so I'll just give you the floor here. What should we be looking out for in 2026, or anything else you want to hit on?
Well, with 2026, there is just a lot of uncertainty. If there's one theme, it is just that we're still in the early innings, and there is just not a clear, there's not a clear vision of what may happen with respect to retail. We heard with the earlier speaker also a lot of uncertainty around AI and how AI is impacting large businesses. A number of retailers almost on a weekly basis seem to issue press releases talking about how AI is positively impacting their business, but it still remains to be seen if they're actually seeing gains, if they're actually able to make their businesses more efficient, because ultimately what drives retail success is both their location strategy as well as whether or not they actually have the merchandise that people want to purchase.
Lots of wild cards. We are definitely living in interesting times. Thank you so much, Sucharita.
Thank you.
And that is all we have for Market Catalyst today. I'm Jared Blikre. Thank you for watching. More Yahoo Finance ahead.